Thank you for taking the time to listen to our show today. I'm Jason MacGregor. I'm the host of the MacGregor Wealthcast. Each episode, we will be discussing topics we believe to be important to our clients.
And welcome to our podcast this week. Hi, everybody. Welcome to the MacGregor Wealthcast. I'm your host, Jason MacGregor, and today I'm joined by Cory Laird. Cory's a certified financial planner and key member of the team.
Good morning, good afternoon, good evening.
All right. So welcome, everybody. Today, our topic is going to be about HSAs. HSAs stand for Health Savings Accounts. And they are growing in popularity. They are a very powerful type of investment account or savings account. And today we're going to talk about, who's eligible, contribution amounts, features, benefits. There's some pitfalls, as with anything. So let's jump right into it. So an HSA, Cory, who is eligible? Are all Americans eligible to an HSA?
Unfortunately, no. And that's probably something that is a good recommendation to all the politicians out there listening, that, this is a great account. A lot more people should be involved in putting money into it. But unfortunately, only those with a high deductible healthcare plan can put money into an HSA. And that's the key, putting money into it. If you already have an HSA, you can still have the money in there. You just can't put more money into it.
Okay, so what's it, just real briefly, high deductible plan? What does that mean?
That's basically someone who has a deductible, an annual deductible of at least $1,400 for an individual, $2,800 for a family. And it also has to do with the max out-of-pocket expenses. There's a limit there as well. Won't go in the weeds there, but sure. It really applies to that high deductible of $1,400 per person.
All right. So I have a high deductible plan, and I have some money I want to save for current or future medical expenses.
Sure.
I know if I was single, I'd be able to contribute $3,600 this year.
That's right.
And oftentimes each year they do ratchet that number up. So in 2021, the dollar amount was $3,600 or $7,200 per couple.
That's right.
And if you are age 55 and a half or older, you could throw in another $1,000 per person. Key there is, unlike a traditional IRA, where the catch-up provision is age 50 and over, the HSA catch-up provision is 55 and older. Yes. Just to confuse you.
Yeah. That's right.
Why make things simple? Sure. All right. So, Cory, I'll throw it over to you. Tell me, what are 2 or 3 really cool features? Why do you like these accounts?
So the cool features about the HSA, the health savings accounts, it all comes down to the taxes. Okay. When you put money into these accounts, it's tax deductible. And the really sweet thing about the tax deductible portion of it, when you put money into it, is if it's an HSA through your employer, not an HSA that you have just by yourself, but an HSA through your employer, it's tax deductible on the federal, the state, and the FICA.
Nice. That
FICA is another 7.7% tax deduction. And there's very few things that are FICA tax deductible. Your 401ks are not, for example.
Okay.
So it's tax deductible going into it. And when you have the money in the HSA, certain points, when you get enough in there, many times you can start investing the money. When you have interest, dividends, profit from investing that money, it's all tax-free. Right. So you don't have to worry about paying taxes while it's in the account, hopefully making money in there. And the third feature, it's tax-free coming out of the account, assuming the big if here is the qualified medical expense.
All right. Well, before we talk about the qualified medical expenses, sure. I want to ask you a question about one thing you said. If your employer offers an HSA, so I'm an employer, right? Yep. I offer a series of medical plans that you can choose from each year. And let's say you and your wife choose to go on the high deductible plan. I don't offer an HSA per se. Yep. So if your employer doesn't, what do you do?
Your best bet is to find a brokerage, a firm that would offer an individual HSA or a family HSA. Charles Schwab has one now. Fidelity has one. The key here, and this is one of the downsides of HSAs, is the fees are relatively high. So if you don't go with one of the discount brokerages like Schwab and Fidelity, you got to watch out for these fees that will just start dinging the account. You start getting up in the 2% range on the fees, or even higher, frankly, because a lot of these fees are just fixed dollar. So $25 a month. If you're only putting $50 a month into it, that's 50% fee. That's not great.
Right.
So the fees can be relatively high, and most of them are fixed dollar.
Sure. So local banks, a lot of providers, Google,
Sure.
HSAs, and there's a lot of different options. So your employer does offer an employer, so then you would come out of payroll deduction.
That's right.
Right, just like 401k, but even better.
Yep.
So if your employer doesn't offer you one, and you are covered by a high deductible plan, you can still go out and find one and contribute. You just write them a check or set up an ACH link on a monthly basis and contribute that way.
Yeah.
All right.
And before we really dive into it, the HSA is a very powerful account. And I really wish that other Americans contribute to it if they don't have a high deductible plan.
Sure.
But be aware that, it may not be best for everybody. If you and your family needs a platinum plan or a gold plan, something better than a high deductible plan, then it just may not make sense to do it. So keep in mind that. Yeah. And the second point, if it's through the employer, sometimes the employer will put money into the HSA for you. So that would be something to look on your benefits list and see if they do that.
Don't get trouble, Cory. All right. So let's talk about a couple other features here.
Yeah.
Portability is one thing. If you do have your money let's say you have your money in a bank at HSA and all they're offering to you is a savings account or a CD, which are earning point nothing, you can roll that money from your local favorite bank to Fidelity or Charles Schwab or any of the investment firms and actually put the money into something that's more growth oriented. So that's the portability feature.
Yeah, you think about you contribute to the account and you're thinking, yes, I got the tax deduction, but if you don't invest the money or if you don't see it grow, you're missing a key portion of it, is the tax-free growth of it.
That's right. Yeah. So it leads me to the next point, which is if I'm healthy, knock on wood, I don't have to go to doctors very often. So I don't have any medical expenses. So I don't want to put $3,000 into the account because I'm worried that I'm not going to use the money by the end of the year. Is an HSA right for me?
Well, you got to be aware that the FSA, the flexible spending account, the FSA has you got to use it by the end of the year.
That's right.
And so many of you probably are going to Walgreens December 31st, buying everything you can.
Right.
The HSA is rolled over into the next year. So you don't have to use it by the end of the year.
Really nice feature. So you can start to accumulate some money during your healthy years, knowing that someday you're going to have some medical expenses, most likely. Okay. And we'll talk about one of the big expenses that you're going to have if you're under 65. We know you're going to have some costs once you turn 65, i.e. Medicare, right? So there is a whole host of qualified medical expenses, whether it's medical, dental, mental health. There's a whole list, and actually IRS publication 502 lists them all. Okay. It's very inclusive. So the idea that, I don't want to put money into an HSA because I might not ever have to use it, I think is an irrational thought, frankly, because you're going to have those expenses. And I mentioned a minute ago, Medicare. So, I'm 50, but let's say I'm 60 and I'm still working, I'm still put some money in, I'm healthy, I'm not going to doctors, and I've accumulated 10, 15, maybe $25,000, $30,000. And then I turn 65 and I sign up for Medicare. What happens then?
So a couple things happen there. So when you turn 65 and you go into Medicare, it's really the Medicare that makes this transition period actually happen. It's not just the magical age of 65. It's when you get onto Medicare. That's a different conversation. So when you get onto Medicare, the HSA continues to become, it's just an HSA. It's a normal HSA. But when you sign up for Medicare, you got to remember that to contribute to an HSA, you must have a high deductible plan and only a high deductible plan. Medicare is not a high deductible plan. In fact, many times, if you sign up correctly, many times deductible is zero. So it's certainly not a high deductible plan. So for those who turn Medicare on, you're no longer able to contribute to the HSA. Now here's the rub. There's a little side rule that says you can't contribute to an HSA 6 months before you jump onto Medicare. And that's kind of hard for people to, first off, know about and to remember that 6 months before you turn Medicare on, whatever that point is, 65 or whatever age, you cannot contribute to an HSA anymore. And if you do, you must take it out.
All right. So as a general, if I make a general statement, HSA and Medicare really don't play very nice together in the same sandbox. There's definitely some rules. Now you don't take the money out of the HSA. You said that. You just can't contribute at that point. So you might let the money continue to grow.
You could.
All right, if you want to. So I've been healthy. I'm 60. All to my 60s, I was blessed with good health. I wasn't using the money, but now, I have no major medical expense on the horizon, but I'm paying for a Medicare premium. I can use HSA funds to pay that premium, can I?
That's right. Yeah. So, what's considered a qualified medical expense? That's when you take money out of the HSA and you use it for a qualified medical expense for it to be tax-free coming out of the account. You can use it for COBRA premiums. That's important. If you lose your job and the bills are probably going to be tight there, if you can use those HSA balances for the COBRA premiums, that's important. But as you said, it can also be used for Medicare premiums as well. So if you're paying $300 a month for you and your spouse, you can just take that right out of the HSA tax-free. So it's a nice little feature.
All right, really nice. So, any other comments you want to make about, any features, positive things? We talked about tax deductible, tax-free growth. An example I'd like to say is, let's say I do contribute. I'm covered by a high deductible plan. I contribute to an HSA this year. I put in my $3,600. I do have to go to the doctor's next week and get my wrist looked at. So should I put the money in this month and then take it right back out the following month to pay for that bill?
I mean, you certainly could. You certainly could. So a couple of the pitfalls and some things that are very, very specific to HSAs only. This is very unusual, but one of the limits to an HSA is the contributions. It's a good idea to only contribute on a monthly basis because, as you said, there is a $3,600 per person annual limit, but technically speaking, that's a monthly limit.
Mm-hmm.
And if you put more, so 3,600 divided by 12 is the monthly limit. If you put more than the monthly limit and you are not on a high deductible healthcare plan for the full 12 months from that point on, and so it's forward facing there, you would have to take it out, the excess out.
Okay.
And so it's a very weird system where, yes, there's an annual limit, but there's a monthly limit as well to watch out for.
Okay. And where I was going with it is if I put the money in now and then take it back out next month, I am foregoing one of the key features of the plan, which is tax-free growth. So if I have the discretionary income to go pay the copay or my prescription drugs, do that. Our advice typically is to let the HSA balances grow for a while and pay those other costs out of pocket to get the tax-free growth. That's where I was going with that question. But I appreciate you diving into the weeds about that. I know half our listeners just turned it off, but we'll hopefully bring them back here. So we talked about a lot of features. You mentioned a couple of pitfalls with Medicare not playing very nice with the high deductible plans and HSAs. Any other pitfalls that you want to share before we give some more information here? Yeah.
So you got to think as when you take money out of the HSA, if you're before you turn Medicare on, so if you're, usually it's pre-65, and if you're not using this money for medical expenses, be aware there's a 20% extra tax. Yeah. So it's taxed and there's a 20% extra.
Sure.
So that's big. So just be careful of that. Make sure it is qualified.
But the list of covered expenses is so vast.
And frankly, something fun that you can actually do with the account is you don't actually even have to have a medical expense for the current year. If you have a receipt from a surgery from like 5, 10, 20 years ago, you can actually use that receipt to withdraw money from the HSA this year, and it is qualified.
I just wanted to point out to our listeners that Cory called that fun. We do have a difference of opinion on what fun means, but anyway,
fun.
Yeah, that's a fun fact for you. So, all right. So all things HSA, yeah, we probably talked about a lot of them, but obviously there's always the details of the weeds and all the nuances. Encourage our listeners and viewers to go to IRS publication 969.
That's right.
Okay, that talks all things HSA. Pair that with publication 502, which lists the full range of medical and dental expenses that are covered. And you'll find that, I think you'll agree with us, that this is a very, very powerful tool, often underutilized. They've been around for a while, and the traction, they're starting to get traction, but a really, really good account. So encourage our listeners and viewers to give us a call if you have any questions, whether your employer offers it, whether you're going out to the marketplace to find one, whether you qualify, how you should contribute, how you should invest the money. We love talking about this stuff. It's fun. It really is. It is fun stuff. And as always, if you have more questions, reach out to us at 518-499-4565. That's our direct number. Our website is mmwealth.com, and our email is info@mmwealth.com. So thanks for taking a few minutes and listening to our Wealthcast. And as always, we're here to help, and thank you very much.
MacGregor Wealth Management is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Information presented does not involve the rendering of personalized investment advice and should not be construed as an offer to buy or sell or a solicitation of any offer to buy or sell the securities discussed. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment or strategy will be suitable or profitable for an investor's portfolio. There are no assurances that an investor's portfolio will match or outperform any particular benchmark. All investment strategies have the potential for profit or loss. Past performance may not be indicative of future results. The tax and legal information contained in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation.